Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on WHFS 1580 AM. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you every Monday from 2 to 3 right here on WHFS 1580 AM. And I want to remind you that if you ever have any real estate or credit-related questions, you can call me offline, and I will personally assist you. That number is 877-245-2030. That's 877-245-2030. Today we're going to be jumping into a couple different topics. One is we're going to be giving you the tips for selling your home in 2011, the things that will help you get your house on and off the market as quickly as possible. Also, we want to give a wake-up call to local buyers about expectations when they hear the words short sale and foreclosure. I know a lot of you out there have heard those, that you're thinking you're just going to get this outstanding deal, but we kind of want to, bring this back to a more local, realization that things aren't the same as they are throughout the country. And then lastly, I wanted to kind of jump into the relevance of the meeting between Chinese President Jintao and President Obama, and kind of give you the housing and interest rates, what the relevance to that meeting was and how it's going to affect interest rates long term. Joining me on our panel today is Louis Cammarosano, General Manager for HomeGain. Louis is on Inman News' Top 100 Most Influential Men in Real Estate in the Technology category. Louis, you there?
I'm here, Ryan.
How you doing, buddy?
Just grand. And yourself?
I'm doing well.
Good.
Do anything exciting over the weekend, Louis?
Just a lot of cleaning up.
Did you get a chance to watch the games, or you're not a big football fan?
Not a big football fan. I heard the results, though. There were a lot of disappointed people in Chicago.
Well, it was definitely a cold weekend, so I kept myself inside. But, I did enjoy the games. Also joining us on our panel today is Jim McCowan with Long & Foster Real Estate. How you doing, Jim?
Great. Thanks for having me.
How was your weekend, Jim?
Busy.
Showing a lot of properties?
For 14 properties over the weekend.
Wow.
Yeah.
And, before we jump in, if we have any questions from our listeners today, make sure that you reach out to us on our off-air number. It's 877-245-2030. That's 877-245-2030. So jumping into the business insights of last week, where we're going to recap all the important credit and real estate-related events of the week. On Monday, obviously, there wasn't much going on with Martin Luther King Day. The market was closed, so there wasn't much going on there. On Tuesday, it was a big day because President Jintao met with President Obama. Now, I know a lot of you listeners out there are probably asking yourself, now, who cares? What does this mean to the real estate markets and the credit markets? And actually, it's very, very important that you do understand that. The U.S. has been criticizing China for the weakness of the yuan to the dollar this has been going on for years, this currency manipulation, because China pegs their yuan close to the dollar to keep their exports cheap. Therefore, we're exporting their goods, and who's this helping? It's helping the Chinese, obviously. So the catch-22 with all this is that the politicians have been calling China to allow their yuan to move more freely and rise against our dollar, which would ultimately, it's going to make our mortgage rates rise, because if they stop buying as much of our debt, they're buying our debt to kind of offset what's going on there. And I know, Louis, we had been talking about this a couple weeks ago. This is one of these things that could really drive interest rates up in a hurry.
Correct.
Not a good thing. I mean, we were talking, Jim and I were talking before the show started. In the Northern Virginia, Washington, D.C. metropolitan area, I'm not as concerned about unemployment. However, the mortgage rates rising, oil rising is more of the things that we want to look to as indicators of what's going to go on here. I know you give a better national outlook. What are your thoughts?
Well, Ryan, I think what's interesting with the Chinese, at some point they're going to wake up and realize that the outstanding debt obligations that are owed to them may not be paid because of the fiscal obligations of the United States are too great to ever pay them back. So at some point, and they've already started this process, they're going to start scaling back on purchasing our debt. And when that happens, by definition, the United States is going to have to raise interest rates to either attract them to buy more or to attract a substitute purchaser. The problem is, I think the Chinese own half of the outstanding treasury, so it's going to be hard to find somebody else to step up to the plate to purchase that. So the only thing that's going to happen is prices are going to rise. And what you also see in terms of inflation and why interest rates are going to have to rise is while we haven't seen the consumer prices rise, we've seen tremendous amounts of increases in the prices of commodities, gold, silver, corn, and so on. And the reason for that is your standard definition of inflation is basically a lot of dollars chasing fewer or the same amount of goods. And we know that the world is awash in dollars. For one reason, the U.S. is the reserve currency, and all the countries have to settle in dollars. That inflation has been exported to countries like China, but at some point that imbalance will shift back and inflation will hit in the U.S. And as you point out, rising interest rates are going to be the result here in the United States as well as inflation.
Yeah, and that's, that will put some pressure on housing, obviously, there. And, I think between this and the quantitative easing, too, which was, when the Fed basically put a $600 billion, they haven't fulfilled all that yet, buying, short-term bonds, 10-year treasuries and 7-year and 5-year, everybody thought that this was going to keep interest rates low because they didn't realize that they weren't actually buying the 30-year mortgage-backed securities any longer. They were now buying short-term bonds. Yeah. So I think it's going to be interesting. I think what we should take from this, Jim, is that, right now with the low interest rates where they are,
it's the time to jump.
It's the time to be proactive, versus reactive, which I think is most of the general public at this point.
I agree. I mean, signs are pointing. Things are only going to go up, and if you're on the fence, now's the time to get off. I mean, it really is.
Yeah, I mean, and I talk to my clients every day, and their top 3 reasons right now why people would want to even just to say refinance is, to lower your term,
right?
Get a better interest rate for your term. For home improvement, you can borrow money as cheap as possible right now versus, what we had before when we were at 6%, and also pull money out to invest in other real estate. Right. I know that I've talked to numerous investors, people with a lot of money, and they're all saying the same things, that there's opportunities out there for them to take, cash and buy an investment property and rent it out and actually have a positive cash flow there.
Right.
And I think the days of buying real estate just because it was a good investment are kind of, out the door. I mean, long term, that's a good idea. But
right.
For people buying primary residence and expecting to get rich quick overnight, it's just
no, it's not going to happen. No,
I know you're kind of in Arlington, which is a high-end area.
Right.
What are you seeing as far as just sales? How quick stuff's moving? Are you seeing a lot of action?
I am. I was just talking to another Long and Foster agent who kind of threw a property coming up out on the market in Arlington. First open house is going to be next Sunday. Went under contract yesterday.
Yeah.
I mean, things, again, if they're priced right, they're going to sell. People want convenience, and it's expensive in Arlington.
Right, yeah, it is.
I mean, when you look at the Orange Line corridor, everybody wants to be there.
Yeah.
Especially first-time buyers. One of the hottest areas in the country.
Yeah.
I mean, literally, and it costs.
Yeah.
Got to be prepared.
Yeah. Well, Louis, you did your company does a quarterly survey, correct?
We do two quarterly surveys. We do a quarterly survey on home prices and the expectations that real estate agents and homeowners have on the direction of home prices.
Gotcha. And I think I remember reading the one that you just sent out to me recently about the Washington, D.C. metro area, around Northern Virginia. You want to give those results to our listeners? I mean, I think there's a pretty good indicator of the optimism level is a lot higher here than it is in most places.
I don't have the Virginia ones in front of me. I have the national ones.
Okay.
And as you recall, the Virginia area has a higher level of optimism on the direction of home prices versus the rest of the country.
Yeah.
And that's largely because of the employment situation there. But you have to be careful with pegging home prices to employment prospects in the D.C. area with the new Republican Congress looking to cut spending, because that could all turn around in a hurry. Because if you think interest rates are low and you expect them to go higher, remember, if interest rates go higher, that makes it more difficult for people to finance the loan. But if you have concurrent with that declining employment in the D.C. area because of a reduction in employment opportunities or layoffs, then the interest rate advantage may not really be an advantage in the D.C. metro area.
Yeah, that is, once again, us assuming what our government's going to do. You know what I mean? It seems like every time they say they're going to reduce something, they just end up printing more money anyway.
That's correct. But as you know, if they don't make the cuts, but they print the money then your interest rates will go up.
Oh, yeah, absolutely. And, I mean, we've seen that over the last, 2 months from November to now. I mean, people that were sitting on the sideline trying to not only, thinking the prices were going to bottom out further. They were trying to time the interest rates and that at the same time. It's just impossible to do that.
It is, yeah.
Nobody has the crystal ball. And I think I've said this on numerous occasions that, buying a home is not for everybody.
Right.
And I think that there's a lot of organizations and people out there that kind of lead people to believe that they must own a home. I don't think that that's the case. The people that, can sit down and look at all their options and say, what, this makes financial sense for me. I'd rather pay $2,000 a month. I plan on staying here for 5 years versus paying, and what you told me, Jim, $2,300 for a one-bedroom apartment in Arlington.
Yeah, rent. I mean, that's just, think of the money on a year that's gone out the window.
Yeah, it's crazy. I mean,
that's a heck of a mortgage payment.
Well, I just can't see. I can't see myself paying $2,300 for a one-room apartment in Arlington, regardless.
Yeah.
But I think that that kind of leads me to the other thing is that these rental prices, and I don't know, do you track rental prices at all, Lewis?
We don't, but I know a company called Trulia produces a rent-to-buy ratio, and right now, to Jim's point, I think in 70% of the top metro areas, it's actually cheaper to buy than it is to rent.
Yeah.
The other day.
Yeah, and we're seeing that definitely in our area, just because there's the inventory is relatively low, and when it's low, there's only there's not as many homes you go out there looking to buy, so people get into a situation, or if they're coming out of a short sale, they're drying up all this rental inventory. There's not much there. The price has been shooting up. One of my clients is actually telling me they were trying to figure out whether they were going to buy or rent. In a 3-month span, it jumped up almost 10%.
Yeah.
So, I think that this is going to heavily weigh on the decision moving forward in a lot of areas, just based upon, the rentals moving up so fast.
Well, that's especially true in the areas where the home prices have taken a real shellacking.
Yeah.
It's not true in New York. It's not true in San Francisco, but it is true in areas like Phoenix and others where there's tremendous numbers of foreclosure. There's a glut of inventory. The prices are cheaper than renting. Yeah.
Let's go ahead and move for Wednesday of last week. The House was looking to repeal the health care bill, and I think that this is going to be an ongoing battle for the indefinite future. This is just another trying to figure out money, and do we have the money for this, and is it actually helping anybody?
Right.
On Wednesday, also, the refinance index rose 7.7%. I find this kind of funny. We have the index rising, which means more people are applying for refinances. It's kind of like, okay, what were they waiting for from before?
Yeah.
And I think that this mentality out there that, interest rates were going to get lower, I think a lot of people got sucked into that saying, okay, well, they were at 4%. There's no reason why they can't go back there. And that's just because they don't want to look at the general economy or they're listening to the national media, telling them all these different things, and they think that they could time it perfectly.
Yeah, well, if we could do that, we'd all be a heck of a lot richer.
We'd all be millionaires in that case.
Yeah.
I can't tell you 3 or 4 clients that did try to time it. I'm sitting here looking at my rate alert, tracking it, and the rates tend to follow in a 20-day moving average. And I tell them nonstop, I'm going to say when it starts to slide, and it slides fast, rates are quick to go up.
Right.
And very, very, very slow to come down. And the 4% that we saw, I think, is going to be something we might not see for the next 100 years. Literally.
Yeah, it's possible. You're
or
right.
if it ever happens. Would you agree, Lewis?
I would agree, and I think if you have cash and you can lock yourself into a long-term mortgage, you're going to be in good shape because you're going to pay your money back in inflated dollars.
Yep.
And it's the banks this time are going to be on the hook for those because if interest rates are higher and they're only getting back 3%, 2, 3, 5, 10 years from now, that's quite a bargain for the person who took that mortgage out.
Yeah, absolutely. That's why I've been preaching that for a while now, saying that, actually buying a home and having an asset there is a way to protect yourself against future inflation, which we know is inevitable.
Yeah, it's coming.
Especially if you're paying your mortgage in pre-inflated dollars.
Yep, absolutely. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano with HomeGain and Jim McCowan with Long & Foster. We're going to jump ahead to Thursday where the jobless claims were reported of last week. And initial claims for jobless benefits fell by the largest amount in nearly a year in the week ending January 15th. The Labor Department reported that the number of Americans seeking first-time unemployment benefits dropped by 37,000 to reach a seasonally adjusted level of 441,000, which is the biggest weekly jump since February 6th of 2010. I always have had a problem with the unemployment numbers, the way they're calculated, and they don't take into consideration the people that have stopped looking after 6 months.
Right.
And, a lot of the things that they can really manipulate these numbers, and I think it's it's to mess with the consumer confidence, I think, is all it really is.
Oh, I agree.
And employment is known to be a lagging indicator because you have a lot more companies now that are going to try to take their employees and get more out of them. So if you were working 40 hours, we might make you now all of a sudden we have more orders coming in. We're going to let you work 45 hours.
Right.
It's going to take them until they have to get to, 80 hours with that one employee before they're going to hire another person.
Sure.
So, these jobless numbers don't mean much to me. I know that nationally our numbers, what is 9.6% that keeps moving all around. Right. That's not even the real number. The real number nationally is probably closer to 16, 17, 20%. I mean, it's up there. Wouldn't you agree, Lewis?
I would. Well, I think one of the reasons you're going to have a little bit of a bump in employment is the uncertainty over taxes has been removed. Obama and the Republicans did reach a compromise, so to speak, where taxes will not go up, have not gone up in January. That will help. But structurally, when spending still makes up 70% of our GDP, until the United States, that changes to a more productive percentage, where GDP is a larger percentage based on producing goods and exporting them, the employment situation can't get that much better. And also, a lot of the jobs created in the past couple of years have been in the government sector, and with states now undergoing some austerity measures, those jobs are going to go away. So the real key to recovery and employment is keeping the taxes at least where they are, and then funneling those jobs into productivity.
Yeah, agree
so
there.
So far that hasn't happened, and I guess that's why they're trying to push the yuan so that it becomes more expensive, so that our exports become more attractive overseas. The only issue we have there is we've eliminated a lot of our productive capacity, so that may not really do the trick either, just changing the currency peg.
Yeah, that's true. Also, another thing that was reported on Thursday, where the existing home sales report showed a gain in December of 12.3%. Sales of distressed homes, which include foreclosures and short sales, rose to a 36% market share in December from 33% in November. Now, obviously, Jim, we were talking, and this is not relevant really to our area. I mean, you were talking about, you pulled a statistic in Arlington.
Yeah, I did a quick search this morning through the MLS, and right now in Arlington, as of this morning, there were 529 properties on the market, and only 30 of them were identified as short sale or foreclosure. I mean, that's like 0.6% of the houses available. I mean, unheard of in the rest of the country.
Yeah, and I mean, I think that we're in a completely different area where it's not the same as, Florida, Nevada, California, these different areas. But it kind of, the buyers that we have out here that see, these national statistics that say that the short sales and foreclosures, and they're going to get this great deal.
Yeah.
I mean, I really think that they have a misunderstanding of what's going to take place when they start to look at the properties that are available.
Well, it's true. I mean, they see a list price, and even on Trulia, I see all these questions all the time. What's the percentage I can offer below the list price on a short sale or foreclosure? No, I mean, it doesn't work. The banks have lost money already.
Yeah.
They may put on a price, and you may submit an offer for that list price. Well, 10 to 1, the bank's going to sit on it, hope that somebody else will come in.
Well, doesn't the agent, they initially set the price anyway?
Well, for a short sale, it's the agent and the current owner.
Right.
The bank's not involved yet. And once it goes to foreclosure or becomes a bank-owned property, generally the banks will do their own appraisal.
Right.
And again, and again, general statement, a lot of people think they kind of see that price and automatically think lower.
Right.
And what happens a lot of times is if it's a property in a desirable area, you're going to get multiple offers.
Yep. And,
I mean, several short sales and foreclosures that I've done recently, you have wound up going above the list price.
Right.
I had one client on a house in Woodbridge, which is, outside the Beltway, beautiful home, great price. There were 16 offers on it. We wound up going in 10% over the list price.
Right.
We got it, but at 10% over the list price.
Yeah.
So, again, the appraisal came in. Where did it come in? At the list price.
Right.
So the bank, obviously, fine, they lowered it. So my client got a great deal.
Yeah.
But again, a lot of competition out there.
Yeah, and then even on the foreclosures, I mean, I think that we're seeing that a lot of investors are stopping. They're not looking for the flips that they had going on before. Now it's kind of more of the buy and hold mentality.
Yeah.
But let's say that you're able to get a 15-20% reduced rate because it's a less here than it is the rest of the nation for what the amount of percentage that they're getting discounted.
Right.
But by the time they get in there and have to do all their work, they're right back to, maybe 5% underneath what they would pay the going rate anyway.
Well, exactly. Unless they've got a wad of cash for the improvements, they're going to have to finance those improvements somehow, whether it's on credit cards or whatever. So, when you take your mortgage payment and then add on, a $10,000 kitchen or a $10,000 bathroom, you're bumping your mortgage payment up where you probably higher than you thought. So it's tough sometimes to look at the entire picture of what a house is really going to cost you.
Yeah, and I think it's important to let our listeners know, at least here, that just because you see things in the national media that short sales and foreclosures are going to lend itself to the best deal, that's not always true. I mean, especially with the financing costs being so low right now. When you're talking about interest rates, let's just say I think Yahoo is reporting 4.75% is the average right now.
Right.
But with the lending costs being so inexpensive, it makes sense to kind of maybe buy the home that's already fixed up that you don't have to do anything to, because when you're looking at breaking it down monthly,
right,
what that payment's going to be versus having to go up and run up your credit cards and everything else, and then having to add that on, because that's a payment you have to make.
Well, it is, and again, a lot of people are doing the FHA loans today because down payment is 3.5%, and a lot of these foreclosures, the homes won't even qualify because when you get the appraiser in there, he's going to nitpick. I mean, they've got very specific guidelines they got to follow, and I've heard of instances where they just say no.
Right.
We're So again, foreclosure, short sale. If you're doing FHA, you got to be careful.
Yeah, Louis, what are you seeing out? Where you're at as far as distressed sales? I mean, are you seeing it being a significant difference between list price and what the actual the going market value would be?
Sure. The HomeGain survey actually tracks from top to bottom what homeowners think their homes are worth, what the real estate agent thinks they're worth, what they then list the home at, and what it sells at.
Right.
And it's a waterfall. And then it's not surprising that buyers start out thinking homes are overvalued. So if you look at the national statistics, 67% of homeowners believe their homes are worth anywhere between 10 and 20% higher than the real estate agent's recommended listing price.
That's a shocker.
Okay, and then when you go to listing, 70% of them end up being listed between 5 and 20% less than the price that the homeowner wanted, and then they actually sell. 81% of them sell below the listing price. 55% sell 5 to 10% below the listing price. So the expectation on the part of the seller is still inflated. And then, of course, the buyers coming in thinking, they're hearing all this news that you can buy a house for next to nothing.
Right.
That really drives the dynamic. The other thing about the buyers who come into the thinking that they're going to get a good deal, sometimes, as Jim was mentioning, we hear this from the HomeGain members all the time, the short sales fall through because the bank doesn't accept it. Everybody thinks this is an acceptable price except the bank.
Yep.
And they're the owner, so you're out of luck there. But the real key is when you see these types of statistics where homeowners have to be talked off the ledge, they have to list the price, and then they get sold for less than the listing. That's where, we could talk about in the next half-hour segment why it's so important to get the home ready for sale in the first place.
Yeah.
They're the ones that are going to have the best chance of
Yep.
selling closer to what you want to get.
Yeah, and, we're going to, coming up after the break that we have here in just a minute, we are going to discuss the top tips to selling your home in 2011 to, get people, moving and have realistic expectations there. But also, it's funny you bring up that point, Louis, because I think that there's also, when people are going after these short sales, there's an opportunity cost of, that they might have an actual loss on this thing, because if they end up waiting 6 months, I mean, I told you, Jim, I had 6 deals sitting on my desk, short sales, that I originally pre-qualified these people at 4 to 4.25%.
Right.
So they've been sitting around waiting for 4 to 6 months
For an answer.
We still don't have an answer, and now they're coming back to me, and I'm telling them, hey, we have to get you pre-qualified. What do you mean we have to get pre-qualified? Well, because the interest rates have now shifted up 0.5%, and you're looking at a $400,000 home.
Yeah.
And your credit may have changed in that interim.
Oh, and you know what? I would say 9 times out of 10, there's something subtle. I mean, it might not have changed it by that many points, but with all the credit risk adjustment pricing now. I mean, literally, the difference between 720 and 719 is pretty substantial these days.
Yeah.
And we all know the story of the guy or the woman who's going to buy a house and they go out and they spend $20,000-$30,000 on new furniture.
Yep.
On their credit card.
Yep, that happens.
That impacts negatively their credit score.
Yeah, well, we're coming up on a break. When we come back, we're going to jump into the tips to selling your home in 2011. You're listening to Real Estate Radio. Be right back.